Hello, this is Tom with Plan for Your Tomorrow. Welcome to our webinar on Social Security claiming. As we are always looking for ways to enhance our capabilities and to serve our clients better and in more ways, we have added a new Social Security analysis tool as part of our PFYT Planner financial planning process. We are calling it the Planner SS and bring it to you with the help of Social Security Solutions, who provided the technology. This educational program is based on their material. Now please take a brief moment to review a couple of important disclosures. I'm not sure many folks associate Social Security with a strategy. We talk about strategy in terms of games like chess or for sports like football. Social Security is really no different. Just like winning at chess or winning in a football game involves careful planning, so should your Social Security claiming plan. As this slide says, there are literally hundreds of claiming combinations, but the one that's best for your situation will analyze all of the household factors that play a part in your benefits. Getting it right is critical. You are locked into your choices with little opportunity to change your mind, and you could be leaving a lot of money on the table. Our presentation today is designed to give you the basics that you need to know and consider as you plan, but there is no way we can give you the answers here. This is complicated and you need advice. The Social Security Administration agents are prohibited by policy from giving you advice. They can answer some of your questions, and by the way, you will often receive inaccurate information from them, but they can never give you advice. That's where our firm can help, and we'll tell you a little later about what we can do for you. Here are the most common questions that our firm gets about Social Security benefits. Will the benefits be there when I'm ready? What about the recent changes that I've been hearing about? And will Social Security be enough? How much will I receive? And what is the best way and the best time for me to claim my benefits? During this session, we will answer many of these questions to some extent, and some of the answers may surprise you. The first and most common question that we receive is, will Social Security be there for me? The short answer is yes, but we'll go on to take a look at this in a little more detail. The media has created a great deal of hype about Social Security. Sadly, the political charge attached to Social Security carries with it the ability to instill fear in Americans when most experts believe that no fear is warranted. Social Security is recovering well with the economy, and recent changes that we'll discuss in a few moments have shored up the system. Each year, the Social Security trustees release their report about the state of the fund. In 2015, the report indicated that Social Security was strong and recovering. The prediction was that there would be enough in the fund to pay out promised benefits until about 2034. After that, about 79% of all the benefits could be paid out. And this is if nothing were done to shore up the system further. Additionally, trust fund income was determined to be ahead of expenses by about $9.2 billion. And the projection was that income would exceed expenses all the way through 2019. Recent changes to the law are expected to further increase and improve the state of the fund. All in all, Social Security is just fine. There's no need to panic or to claim benefits early and fear that they will go away. So what about the recent changes? The news media has certainly made it known that there have been some changes, but the explanations have not been very clear. Well, the Bipartisan Budget Act of 2015 was signed on November 2nd, 2015, and it created a few changes to Social Security. The main changes impact two ways to claim benefits, or strategies. These two strategies were commonly called file and suspend, and filing a restricted application. They were rules within Social Security law that made it possible for Social Security beneficiaries, particularly married couples, to get more in benefits. However, even without these two strategies, there are still plenty of ways to claim benefits in a way that maximizes your cumulative lifetime benefit and protects your family against longevity risk. And there is definitely no need to panic about your benefits. We're often asked whether Social Security would ever be enough to live on. And the answer, which is probably no surprise to anyone, is it probably won't be. The system was never really intended to provide for a comfortable long retirement. When it was originally created, it was designed to cover the very, very tail end of someone's life when their life expectancy was only slightly longer than their working years. So now we consider it a safety net, but not one that will provide for everything. The average retired couple reports spending these amounts on what they deem as necessities. The annual total is $33,057. Now, some of you will spend more in retirement and others will spend less. Given that our necessities can total a fairly large amount, it makes sense to get as much from Social Security as possible. Your retirement may last 30 years or more, and the question is, have you saved enough to last? Maximizing your benefits means that when your savings may be running low later in life, you will still be receiving the most in Social Security. People often wonder how much their benefit will be. And of course, as with so many other things in life, it can depend. How much you will receive in Social Security benefits is based on a number of factors. First, it's based on how much you earned over your lifetime. The more you earned, the greater your benefit will be, up to the maximum benefit amount. As of 2013, the maximum full retirement benefit is $2,533 a month. In order for your full retirement benefit to be $2,533, you must be turning 66 in 2013, or must have turned 66 in 2013, and have earned the maximum Social Security wages for basically every year of your career. Your benefit amount is also determined by the age at which you apply for benefits. If you apply earlier than your full retirement age, they will be reduced. If you apply at age 62, you will receive only 75% of your full retirement benefit. If you apply after your full retirement age, you will get more. You can see in the example here that it pays to collect your benefits later. Benefits are also impacted by your marital status. Married couples can use the rules of spousal benefits to their advantage. Also, survivor benefits for widows and widowers have their own sets of rules that may be advantageous to you. Finally, if you are divorced, you may be eligible for a divorced spouse benefit on your ex-spouse's earnings record. Your benefits can be worth a lot. Most people tend to think about their benefits as being a few $100s each month, but they don't think about the cumulative total over their retirement horizon. Meet Joe and Mary. For this couple, $813,566 in cumulative benefits is more than they thought it would add up to. This means that they will need this much less from their savings during retirement. And while $813,000 sounds pretty good, remember Joe and Mary. Later we'll talk about how they can get even more. The SSA uses a formula to calculate your benefit amount. They look at your highest 35 years of earnings. If you do not have 35 years of earnings, they will average in zeros for those missing years. In order to qualify for any benefits at all, you must have at least 10 years of earnings on which you paid Social Security taxes. Your actual benefits are based on your primary insurance amount, or PIA, arrived at through a formula that is applied to your earnings. Your primary insurance amount is also your full retirement benefit, or the amount that you'll receive monthly if you begin your benefits at your full retirement age. Your monthly benefit can increase in a couple of ways. First, if you continue working and contributing to Social Security, your benefits will be recalculated each year to reflect that. Second, your benefit will increase in years that a cost of living adjustment is applied. You can find your benefit amount by going online to www.ssa.gov/mystatement. You'll set up an online account and receive your statement immediately via a download link. Your statement will look much like the Social Security statements that used to be mailed to your home each year. Incidentally, those statements will be mailed each year to all workers that are age 60 and over. As you can see from this slide, if you file before your full retirement age, your benefit will be reduced. When thinking about the reduction, think backward from age 66 to age 62. Your reduction for the first 36 months from full retirement age, that is from age 66 backward to age 63, is 0.5% per month. Then from age 63 to age 62, it's an additional 0.5% per month. If you add up all of the 5/9 and 5/12, they equal a 25% reduction. That means at age 62, you will receive 75% of your full retirement benefit. Now this slide shows the impact of delayed retirement credits. The bottom line is that for every month beyond your full retirement age that you wait to claim a benefit, you will receive a credit of 0.2% more. These credits are not compounded, but they do add up. If you wait until age 70 to claim your benefit, you will receive 32% more in benefits than if you begin at your full retirement age. Many people ask us, when and how should I claim my benefits? And because there are so many factors that influence how you should claim your benefits, no easy answer surfaces. We can't just say delay as long as possible, because that is something that might be influenced by the timing of other cash flows in your life or your likely longevity due to family history. So everyone needs to have a good claiming strategy that is singular to them, and no two claiming strategies may be exactly alike. The claiming strategy that your neighbors use may not be the appropriate one for you. So it all comes down to having a good personalized claiming strategy for yourself. When you should begin your Social Security benefits depends on a number of factors, as we've said. Some are listed on this slide. Let's set marital status, age, health, and longevity aside for just a moment. We'll take a closer look at those later. But the other factors listed relate to your financial portfolio. Some folks may need income early, while others may be more concerned about having the highest income possible later when your savings may be running low. Some of you may plan to work longer than others. Regardless, when you begin benefits, they should be looked at holistically with your complete financial picture so that you can make the best choice for your own individual situation. The graph on this slide illustrates how the decision of how and when to take Social Security can impact your portfolio longevity. The case represented by this graph is of a single individual with about $700,000 in retirement assets. Each of the colored lines represents an age at which the individual might claim benefits from ages 62 through age 70. It happens that there are no labels on these lines, so I'll walk you through them quickly. On the left, the purple line, which is the one on the top, is representative of a withdrawal at age 62. And as we move down to the next line, the blue line, that is withdrawals beginning at age 64. The dark green line, the next down, age 66. The yellow line, age 68. And then the light green line, age 70. And as you can see, those lines correlate in order to the time at which this hypothetical portfolio is exhausted, with the 62-year-old exhausting their portfolio sooner than the person who began drawing at 70. So withdrawals beginning at 62, even though you got cash flow sooner, in this case still exhausted the portfolio soonest, and the delayed withdrawals had exhaustion happen last. If the Social Security is taken early, income is provided early, resulting in less that must be withdrawn from the portfolio in those years. Of course, the converse is also true. If Social Security is delayed, more income for living must be withdrawn from the portfolio. As you can see, when Social Security is claimed at age 62, the portfolio runs out of money in 2039. If Social Security is delayed, the portfolio lasts until sometime in 2046, about 7 years longer. Even though more income was withdrawn from the portfolio early, the spend down takes longer with the delayed strategy because smaller amounts of money were being taken out in those later years. The lesson is that how and when you claim Social Security makes a substantial difference in how long your retirement savings will last. Maximizing your benefits and choosing a smart strategy that protects you against longevity risk makes a material difference in your retirement income and portfolio longevity strategies generally. So what is a claiming strategy? A claiming strategy is literally the act of combining all of the complicated rules into a personalized plan for you to claim benefits for a particular outcome. The outcome may be maximum cumulative benefits. It may be income at a particular time. It also may involve switching benefits at a particular time or turning on or off a category of benefits at a particular time. But if you don't know all the rules, you may end up missing an important factor in your strategy. Married couples can take advantage of more strategies to get more in benefits. Spousal benefits garnered in combination with retirement benefits can mean the addition of thousands of dollars more in benefits each year. Even if a spouse has never worked outside the home, he or she can claim a spousal benefit on a worker's account. The rules are simple. A spousal benefit is based on 50% of the other spouse's primary insurance amount, and as the spouse of an insured worker, you can generally receive your spousal benefits if you meet a few basic conditions. Your spouse has to have filed for retirement benefits already. You cannot receive a higher benefit already. You are not receiving any higher benefit already. You have filed an application for spousal benefits and you're at least 62. This slide shows some more important information about spousal benefits. For example, if a husband's full retirement benefit is $1,200, the wife can collect up to 50% of that amount as a spousal benefit. It's important to note that spousal benefits do not earn delayed retirement credits, so they are never more than 50% of the earner's PIA amount, their full retirement amount. However, if you claim a spousal benefit prior to your full retirement age, the benefit is reduced. So if you claim early at 62, the spousal benefit will only be about 70% of the earner's full retirement benefit. Once you've applied for your own Social Security benefit, as they say, opened your own record, you cannot claim a spousal benefit unless it's bigger than your own benefit. And in order to claim a spousal benefit, you have to have been married for at least a full year. The recent changes brought about by the Bipartisan Budget Act of 2015 included some grandfathering for two groups. First, if you or your spouse was born before May 1st, 1950, you fall into the grandfathered group. There are claiming options that are still available for this small window through May 1st, 2016. You must reach age 66 before May 1st, 2016 in order to use these claiming rules. You may have read about these rules. They're known as File and Suspend. Our firm uses powerful software that will allow us to complete a claiming analysis and make recommendations for you on how you can claim benefits using the old rules to achieve more in benefits. The second grandfathered group is those born January 1st, 1954 or earlier. This group will be able to take advantage of an old rule called filing a restricted application. This is only possible at or after your full retirement age and is effectively being phased out over the next few years. It allows a spouse who reaches full retirement age to choose whether to claim his or her own retirement benefit or to gain a spousal benefit and let their retirement benefits grow. If you fall into this group, born January 1st, 1954 or earlier, our firm can help you determine if you can use the old rules to garner more in Social Security benefits or if a different claiming strategy would be best for you. So, to recap, if you're a part of two very select groups, you can still take advantage of the quote old Social Security rules that can result in some substantially more in benefits to you, but the window is short. As I've mentioned, our firm specializes in helping you determine how and when to claim benefits, and we can walk you through this complicated process. Let's go back and take a look at Joe and Mary. Remember, with their plan for collecting Social Security, they will receive about $813,566 in cumulative lifetime benefits. Joe and Mary are both age 66 and can use the old rules to claim benefits. So let's look at a better strategy for them that uses some of the old rules. We're going to have Mary claim her benefits a little early, at age 63 and 10 months. With her reduction in benefit, she'll collect about $1,084 a month. At his full retirement age, Joe will collect a small spousal benefit of $634 from Mary's record. Joe claims his own benefit at age 70 when it has grown to $2,664 a month. This increases their cumulative lifetime benefit by $107,481. That means that $107,481 less will have to be withdrawn from their savings. That means that the survivor benefit paid to one of them will be $2,664 for the rest of his or her lifetime, rather than $2,018 if Joe begins benefits at his normal retirement age. But What if you don't fall within grandfathering? What is possible for you? Well, let's take a look. If you don't fall under the old rules, please don't be tempted to just claim early because it's easy. These rules are still very, very complicated, and there are some that you might miss, which could end up costing you thousands of dollars. Again, our firm uses very powerful software that can show you the strategies that apply to your situation, and we can show you the trade-offs between different strategies side by side. Selecting the best claiming strategy for your situation can only be done by analyzing and comparing your options. Remember, there are thousands of rules that can help you maximize your benefits. Let's take a look at one example. John and Abigail were both born after the birth dates that would allow them to take advantage of the old rules. Instead, when John and Abigail are ready to claim benefits, they will be under new rules. John is 61 and Abigail is 59. You'll remember that we talked about the PIA earlier. It's the equivalent of the benefit you'll receive if you claim at exactly your full retirement age. It's the amount that is reduced for an early claim and increased for a claim beyond full retirement age. John's PIA is $2,365 a month and Abigail's is $1,178 a month. Their life expectancies are 80 and 90. In our example, Abigail is going to begin her benefits a little before her FRA at 64 and 7 months. John will start his benefit at 70, and Abigail will qualify for something known as spousal excess, meaning that when John begins his benefit, she'll get a bump in hers. This strategy is the one that will likely pay them the most in cumulative lifetime benefits, over $996,000. Keep in mind, these dollars are all reflected in today's dollars. Their benefits will also grow with cost of living adjustments. Take a look at the comparison between two strategies that are possible for John and Abigail, filing early and taking our recommendation. The cumulative lifetime difference between these two strategies is over $163,000. That means that John and Abigail get $163,293 more if they wait to claim. But the most important factor to point out is that Abigail's survivor benefit will be $1,171 more every month with a delayed strategy. If Abigail lives longer than planned, or if her savings begins to run out later in life, she can count on the higher benefit for the rest of her life. So in summary, what does all this mean for you? First, we hope you understand better that when you claim matters. Sometimes it can be a matter of a month of waiting that will make a substantial difference in lifetime benefits that you receive. The rules are complicated, they are voluminous. While you may be able to do some internet research and learn a few of the rules, the likelihood that you'll overlook something important is significant. You need help with all the rules, and we can help make it simple. There are many combinations of those rules that can help you. We use powerful software coded with all of the rules to tell you the exact strategy that will get you the most in benefits, and we can help you compare other claiming options side by side. Because your decision is irrevocable beyond 12 months, it's critical that you get it right. You just can't afford to make a mistake. Some of you have limited time to take advantage of the old rules to get more in benefits, so don't delay. See us immediately. You need expert advice. Our firm can help remove the complexity and make all of this simpler for you. I mentioned that our firm uses powerful software. Let's talk about what that means for you. With only a few pieces of information that you give us, and we don't ask for your Social Security number, for example, you can get a full Social Security analysis and recommendation. It's a multi-page, personalized report that gives you a recommended claiming strategy. It educates you in simple terms about how Social Security works and how your benefits are calculated. There are graphs and charts that are easy to read. In short, it gives you the answers that you need. So if you want to get your own personalized Social Security analysis done, please feel free to contact us and we'll be happy to help. If you're a current financial planning, advisory, or consulting client, simply give us a call or drop us an email and we'll get started with you right away. If you're not currently a client, we can still do a comprehensive analysis for you. Feel free to check out our website. We have a number of consulting packages that might appeal to you, or just give us a call and we can chat with you about it. Our website is www.planforyourtomorrow.com and our consulting page is www.planforyourtomorrow.com/consulting. We have a lot of information there on some small consulting packages that would enable you to get just this one-off Social Security analysis done. If you have interest in broader planning or broader advisory services, we can have a conversation with you about those one-on-one. We hope you found this interesting, we hope you found it engaging, and we hope you found it informative. And we hope that the most important thing that you take away from it is that choosing your Social Security strategy is worth the time and worth the energy to do right. Feel free to reach out to us and we'll try to help you do just that.